All right, let's jump right in. Today, we're going to tackle a question that, honestly, trips up a lot of people, even some really savvy investors. And it's this: why on earth would you ever buy a stock in a company that pays you absolutely nothing? No dividend, not a single cent. What's the point?
So, here's how we're going to break it all down. First, we'll really dig into that big question. Then we'll talk about what value even means if it's not cash in your pocket. We'll look at how growth can be its own kind of payout, and then the actual real-world ways you can make money from these companies. And finally, we'll wrap it all up with the one key takeaway you absolutely need to remember.
Okay, let's get into it. We're kicking things off with what is, for a lot of people, a huge paradox. It can feel like a classic chicken and egg problem when you're looking at the stock market. I mean, think about it. If a company never ever pays you a dime in dividends, why is its stock worth anything at all? It's a perfectly fair question, right? If you can't get cash out of it, what do you even own? Is it just a bet that someone else will come along and buy it from you for more money down the road? So to really answer that, we have to start thinking a little differently. We've got to look way beyond just those immediate cash dividends. It's all about redefining what it really means for a company to pay you back.
And here's the absolute core of it. A stock's value isn't just about what you get today. It's the value of all the cash that an owner could possibly, eventually, pull out of that company. You're buying a piece of the entire future of the business, not just a ticket for this year's profits.
Okay, so you're probably thinking, great, but how does that future cash actually end up in my bank account? Well, there are a few key ways. The company might not pay dividends now, but who says they won't in the future? They could also do what's called a share buyback, or the whole company could get bought out in an acquisition. And worst case, if it all goes south, there's liquidation. All of these are paths for that value to get back to you, the shareholder.
And that leads us to this really interesting idea of the growth payout. See, companies have a choice. They can give you a little slice of the pie right now, or they can take that slice, put it back in the oven, and bake a much, much bigger pie for everyone later.
This is that choice in a nutshell. On one hand, you pay a dividend, you take that small slice of the pie now. On the other hand, you reinvest those profits to grow a much bigger pie for later. If a company has a fantastic opportunity, say it can take $1 and reliably turn it into $3, you want them to reinvest it. That's how real wealth is created.
And if you want the poster child for this strategy, look no further than Amazon. For more than 20 years, Amazon reinvested every single dollar. Investors got nothing in dividends. And you know what? They loved it, because they knew every dollar the company kept was being put to work to build an unbelievable empire, making their stock price just explode in value.
Okay, so let's move on to the real profit triggers. We've talked about the theory, but what are the actual concrete ways that companies create value for you without ever sending a dividend check?
First up is the share buyback. You can think of this as a kind of stealth dividend. The company uses its profits to buy its own stock right off the market, so the total number of shares goes down. And what does that mean for you? Well, it means your slice of the pie just got bigger, and you didn't have to do a thing. Each of your remaining shares is now worth more.
Then you have the big one, an acquisition. This is when another company comes along and buys the whole shebang. For shareholders, this is often the ultimate payday. All that value that's been building up for years, it gets paid out, either in cold, hard cash or in stock of the new company. It's the finish line.
And of course, you can't talk about this without talking about the master himself, Warren Buffett. His company, Berkshire Hathaway, hasn't paid a dividend since 1967. Think about that. Instead, he's used all those profits to buy other amazing businesses, just growing and growing the core value of Berkshire.
And this quote from Buffett just sums it all up perfectly. We would rather earn 10% on $1 billion than 20% on $1 million. See, it's not about the highest percentage return. It's about making a good return on a massive, ever-growing pile of money. That is the magic of compounding.
Okay, so this all brings us to our final takeaway, and we're going to answer the ultimate skeptical question, the one I bet some of you are thinking right now.
And that question is, but what if I'm the last person holding the stock? What if the music stops and no one else wants to buy it? It's a great question, and it's a legitimate fear. But the good news is, for a solid company, there are some pretty powerful safety nets in place. Here's what protects you. First, your stock is a legal claim on the company's assets. If everything went to zero and the company was liquidated, you'd get your share of whatever's left. That provides a sort of floor. And second, there's market pressure. If a healthy company is just hoarding cash and not doing anything smart with it,
You better believe other investors, we call them activists, will show up and force management to give that cash back to shareholders one way or another.
So let's just put it all together here. The myth is that a stock's value comes only from dividends, but the reality is that its value comes from all of its future cash flows. The myth says you only profit from cash payouts. The reality? You profit from capital gains as the stock price grows, from buybacks, or from a final sale of the company.
At the end of the day, it's really this simple. Dividends are optional. Creating and delivering real economic value is not. As an investor, you just want the company to do whatever is smartest with its profits. As long as they're building real value, you stand to benefit. So I'll leave you with this final thought to chew on. If a stock's price really does reflect its future value, then what does today's market, what does any stock price truly believe about tomorrow? It's a collective bet on the future, and it makes you wonder, what story is that price telling us?